This is Chuck Carnevale, and I'm the Chuck in the Markets Up Chuck. And today's blog is titled Reverting to the Mean. And the idea here behind this was the fact that since the markets had such a nice little run-up after falling so precipitously in throughout 2008, now everybody wants to fuss and worry and talk about whether or not it's a real bull market, is it a false bull market, is it we're going to have this big correction, and it can't be real. And I've even had someone say to me that they just don't understand the market. How could it have be rising so much when the economy really hasn't improved that much? Well, the reason in my way of thinking is very clear. It's because the market overshot itself on the downside, just like it occasionally overshot itself on the upside. So let's look at the S&P 500 from a standpoint of its earnings justified level using one of our Graham-Dodd charts. And what you can see here is that the stock price correlates to earnings, in this is a 20-year chart from 1991 up through 1997. The S&P was at earnings or slightly below. Then we had the irrational exuberant periods where stock prices got disconnected. This was one of the first reversions to the mean on this chart, where stock prices had to fall from August of 2000 all the way through October of 2002, but they were simply reverting to the mean. We did have a drop in earnings during the recession in 2001. Stock prices then collapsed and came back to their earnings justified level, and then they rallied again during a pretty strong period from after 2002, 3, 4, 5, and 6 until we hit 2007 and then finally 2008 where the market collapsed. But here's the point of the blog. As you can see, it overshot itself on the downside. When it was, at its low in March of last year, it actually got down to 666.79. It had become undervalued. Today, all that's happened because we're starting to see a slight recovery in earnings come as our economy starts to improve. What's happened is the S&P 500 is simply coming back to a more normalized valuation. Now, historically, the normal PE for the S&P has been around 15 times earnings over the last 80 years, but for the last 20 years, it's been about 17 times earnings because this high valuation area right here simply overshot that. So now if I simply add the normal price earnings ratio of 17 times earnings, which is this blue line here, you can see that this overvaluation caused this to be higher than a more normalized 15 times earnings for 80 years. But even at this level, you can see the market still undershot or overshot. Based on that basis, you could argue that the stock market itself is modestly overvalued at around 19.6 times earnings today. It should be trading at around 17 times earnings, which would put it at around 901 rather than 1,012. But that's the stock market. And as I've always said over and over again, it's a market of stocks, not a stock market. So let's then take our attention off the generalities and move to some specifics. Here I'm moving on to show three examples of companies that actually have histories of market anomalies. In the case of Charles Schwab, I want you to notice how overvalued it had become in the 1999-2000 era, the irrational exuberant area, until it reverted to the mean. Then it followed earnings very closely, and then it did have a pretty good drop in earnings, not due to the recession in the market. But I want you to notice that the stock price dramatically overshot that. Right now, I would argue that Charles Schwab should be trading at about $19 a share today, and by the end of next year, it should be a $25 stock. So all that's happened here is that Schwab has moved back to a valuation that is relevant to its earnings justified level right now. So this rally that we've had in Schwab is not because the economy has gotten so much better, it's because the stock price had become so dramatically undervalued in the first place. My second example was Amphenol, and I want you to see exactly this. Look at the strong correlation between earnings and market price with this company. And once again, we did have a recessionary drop here, although I want to point out now, both Schwab and Amphenol are still very, very profitable companies. They're not losing money. They're not going out of business. But the stock market reaction, which was obviously exasperated by fear, was much more draconian and dramatic than it should have been. And what we have now is Amphenol starting to come back to an earnings justified level. Even at $34 a share, I would argue this is a $41, $42 stock today. So, where Schwab was back almost to its normal value, Amphenol is still very undervalued in my opinion. It has a lot of room to run regardless of what happens to the stock market. Then my final example would be Fiserv, another company that I've talked about in the past. And again, I want you to see how it was overvalued for a period of time here, but it did get undervalued and dramatically undervalued. There was a flattening of earnings, back in 2007, but that was due to an acquisition. They made some accounting adjustments. 2008 was a very strong year for them, and their stock price still dropped and fell, significantly below what earnings would have justified. You can look at this chart. This is a 20-year chart. This stock has never traded at a valuation below this green line until, this this irrational exuberant period. And again, my argument is very clear. It's my opinion. All you're seeing right now is this company coming back to a more normal valuation. This stock is normally traded at 18 times earnings or above, which is connotated by this green line. It's currently only trading at 13 times earnings, and earnings for the company are very strong. This is Chuck Carnival. I hope this has given you a better perspective of what's really going on in the marketplace. As usual, it's Friday. I'll be taking the weekend off. I appreciate all of you who've tuned in this week. I look forward to talking to you again next week. You have a great weekend, and see you soon.